Hello, everyone. Welcome to another episode of The Clueless Capitalist, where we discover interesting startups, interview founders, and help you become less clueless with angel investing. My name is Razi.
And I'm Osman, and welcome to The Clueless Capitalists.
So in this episode, we are speaking to Prahlad Jaya. Jaya is an active part of the startup ecosystem in Singapore. He started Curate, a community with 700 plus founders and investors. He also leads growth at Qapita. So Qapita offers equity management solutions, cap table valuations, and ESOP consulting. So welcome to the episode, Jaya.
Hey Razi, hey Osman. Yep, great to be doing this.
All right, cool. And for me personally, this is like one of the more interesting components of the whole startup ecosystem, and quite big. A lot of us make it up as we go along. And what prompted this particular conversation was really around a comment that another ecosystem professional made about how do you differentiate between like an entrepreneur and just a businessman, between a startup and just an SME. And that was how he referred to, do you have an ESOP plan? And if you don't, then you're not in the startup space. You're not really acting in the best interests of your business and your co-founders and any of the employees that are coming in. You're not taking this seriously. So that's what prompted me to kind of have a look around and see who's active in this space. And Jaya is part of Qapita, which pretty much do everything related to ESOPs and cap table management. So I'm really pleased to hear more from you, Jaya.
I think that's a great way to start the difference between a businessman and an entrepreneur. You know, I was recently listening to Dealbook has a bunch of videos coming out with the interviews they did. It's a conference by New York Times, and they had a lot of really interesting people like Sam Altman, Sundar Pichai, and I think even Satya Nadella. One of them was Jeff Bezos, and in that interview, he was talking about how there are lists for top entrepreneurs, top investment professionals, and VCs, and all of that. But there's no list for top people who have given out, who have created wealth for others, right? What does that ranking look like? And he was talking about creating such a list because he would naturally be on top of that list. If you think about it, Amazon is worth 2 trillion, 2.3, 2.4 trillion right now market cap. And Jeff Bezos' net worth is around 200 billion, right? And where's the remaining 90% of the wealth going? That's a combination of investors, employees at Amazon. And that's the amount of wealth that he's created for others through Amazon. And that just ties in back very well with the point you made about the difference being a businessman and being an entrepreneur. I think that's a key difference. So with that said, today we'll cover an overview on how ESOPs work, how to think of your cap table. See, a lot of early stage founders don't think about these things early on. You're in survival mode. You just want to ship product. You want to get some revenue. You're just looking for investors. And unless you're a serial entrepreneur, you don't think about these things early on. But in most cases, it ends up being very late that founders get these things in order, and just knowledge around how to use SPVs, how to structure their ESOP program, how to even create their ESOP program, right? So the idea of this session is I'll just brief everyone through key concepts that founders should familiarize themselves with around cap table and ESOP management. This is a little bit about Qapita. We ourselves are a startup. We're a 5-year-old startup. Pre-Series B now. We've raised about 40 million and made 2 acquisitions. We have over 2,000 customers across 20 countries and manage equity for over 300,000 employees and investors. These are some of the bigger startups that use our platform. And as Razi mentioned, we have a platform for managing your cap table and ESOPs. We also do valuations as a service, and we have a consulting practice where we teach companies how to go about designing their plans for their employees. So at a very simplistic level, the way you think about your cap table is it's a summary of all the transactions related to the shares in your company. And there are primary transactions and there are secondary transactions. Primary transactions are when you issue shares between co-founders to employees to investors, and secondaries are when there's a transfer of shares, right? So you might hear things like founders taking secondaries or early investors wanting a secondary. That's basically them cashing out on their investment, where they sell shares, either a partial amount of the shares they own or their full ownership in return for cash, right? Those are secondaries. Every transaction has properties in terms of the types of shares. Not all shares are created equal. So what is the instrument? What is the class of shares? What's the price, volume that's traded? And so that's how you think of your cap table. It's basically an amalgamation of all the transactions related to shares. In terms of the types of security that you typically deal with as a startup founder, you have ordinary shares. In US, this is called common stock, but these are the shares that typically founders and employees hold. And you have preference shares. Preference shares are shares with more rights that is typically given out to investors. We'll go into more detail in the future slides as to what that entails. You would also have a combination of convertible notes that you might have issued to raise capital early on without issuing shares directly. That's a form of a debt instrument where it converts into shares at a future date. We'll also go into how that works in a bit. Differential voting rights. So not all shares would have voting rights depending on your way your board is structured. Employees most definitely don't have voting rights. And yeah, so some shares come with that, some shares don't. We'll talk about that. Safes. Yeah, safes, simple agreement for future equity. That's what a safe is. It was invented by YC, Y Combinator, back in 2013. To simplify fundraising for early stage founders. It's essentially a document that is given out to investors who invest a certain amount of capital, don't receive any shares up front because it's very unclear what you're doing as a company, what the valuation is, how do you value each share. So investors just invest largely betting on the entrepreneur, and they do that through the SAFE instrument, which state that at a future trigger event, which is typically your next fundraise, the investment would convert into shares for the investor, right? So SAFEs are a great instrument for early stage entrepreneurs looking to raise capital from individual angels, angel syndicates, and early investors. Finally, we've got options, which we'll talk about today. Options are largely for employees, right? You would have a certain amount of the company that you set aside to give out to employees as the company grows and scales. Every major startup, every mature startup for sure has an employee option pool in place, but a lot of founders don't do this until very late. But when you have serious institutional VCs coming on board, this is one of the first questions they ask. Do you have an ESOP pool? In terms of investor rights, these are some terms that founders should be familiar with. This is in every term sheet, you will see a combination of these terms being used. Liquidation preference is an important concept, right? This is basically when an investor comes on board. Let's take a simple example where your company is worth, let's say, 4 million, and you're raising $1 million now from a new investor, right? That makes your company valuation now 4 plus the 1 million that's just come in, 5 million, right? In this example. What stops you from an entrepreneur just flipping around the next day and selling the company for far less than what it's worth? Let's say after raising this 1 million, I go and sell the company for exactly $1 million. I still own 80% of the company, my investor owns 20%, and I walk away with 800,000. That's often not the case because of this concept of liquidation preference, which states that when an investor comes on board, you would typically have a liquidation preference of either 1x, 2x, in some cases 3x, which states that in the event of a liquidity event, right, which could be the company dissolving, being acquired, going public, the investor must receive at least either 1x, 2x, or whatever the multiplier is on the liquidation preference in their capital, which protects their investment, right? The founder is forced to then increase the valuation of the company to see any real money. This is also an example of how you might read a lot of news around M&A and founders selling their companies and being celebrated as exited founders. But as we all know, we know a lot of them personally as well. Not all of them may make real money because of this concept of liquidation preference, where they would have sold the company just enough to pay off the original investors, and there may not even be anything left for the founders. Anti-dilution, participative rights, I'll talk about this together. Essentially, investors want to make sure that as you issue new shares to future investors, the value of their shares don't get too diluted, right? And so the way they do this most commonly is through pro rata rights, which state that if you raise more money at a higher valuation, let's say within the next 2 years, they have an option to participate in that round by topping up their investment to make sure they still own a similar percentage in the company, right? That's most commonly how anti-dilution or participative rights work, to make sure that your investors don't get too diluted. And conversion terms here, the most common conversion term is a valuation cap. So like I mentioned with safes, right? You might raise money from a bunch of early investors, not knowing what your company is worth, but at some point you would do a priced round, where you do an actual valuation and you get more institutional VCs on board, where it's very clear what the company is worth, and their investment would then convert into shares, right? So let's say they invested 50,000, their investment would convert into a certain amount of shares at a certain valuation. And typically with your safe rounds, you would have a valuation cap, right? So that states that so your valuation cap may be something like 5-10 million. So even if the company's valuation increases much more and you do great as a founder, your original investors have a valuation cap at which that investment would convert into shares. This is again to make sure that, let's say you skyrocket growth and you have an excellent valuation, their initial investment is still worth something meaningful because the valuation is capped at a certain number that you agree upon when you're raising capital. So that's valuation cap to keep note of.
Quickly address some of those questions that you presented about ordinary versus preference shares, and I know this is kind of jumping around a little bit now. I remember Razi and myself having a separate conversation around this not that long ago, and really the question was, well, normally in this type of environment we're investing early on, when our safe notes convert, they usually convert to preference shares, but the details of those preference shares in terms of what preferential rights they have don't really fully reveal themselves until you have actually a shareholders agreement and you've got visibility of the shareholders agreement. So how do you go about managing that at a really early stage for early angel investors?
It can be tricky at the early stage where you've not formally engaged a law firm that you have on retainer, and you have to largely rely on templatized documents available. The safe note is a good example of that. The YC safe now has versions of it specific to different countries. I think they have a Singapore version as well now, which covers a lot of the basic, at least these four rights that I mentioned. It's very clear how they would work in a certain investment, right? So at the early stage, using common templates like that just make it much simpler for investors like yourself, because they have fairly similar mechanics regardless of your investment, and also simple for the founder. So yeah, at the early stage, going with templatized documents is the best way, as opposed to creating your own agreements early on. So ESOPs, right? This is the second part. So we have cap table and ESOPs. Let's talk about ESOPs. Now, ESOPs, interestingly, most people know of ESOPs as employee stock option pool. Actually, that's true. That is a definition, but there is a broader definition, which is employee stock ownership plan. Right? So ESOPs, the options is a popular instrument, but there are also more instruments, which I'll walk you through in the slides over here. So essentially with ESOPs, you want to be thinking, as a founder, you want to be thinking about how do you design your plan? What are the objectives of your company? What are you trying to achieve with giving employees a stake in the company? How do you go about engaging and educating employees on how these instrument works? Because you could have a great plan in place, but if you're not educating them on the value of it, they would just look at their salary and not really value their ESOPs. And so that defeats the purpose of the plan itself, right? And of course, the regulatory and tax environment becomes crucial, especially as you have employees in different markets. You want to be thinking about these things early on. In terms of why equity compensation, why ESOPs, number one, as any seasoned leader would know, the value of alignment in any organization, right? Aligning everyone with a shared mission, a shared goal, a shared vision is super critical, and ESOPs can be a great way to achieve that by making sure everyone feels and acts like an owner to drive entrepreneurial behavior within the company. Of course, it allows employees to participate in the upside, as you covered with the example that you shared, Osman, and what I shared about larger companies today like Amazon, where most of the company's shares are with investors and employees and not just the founders. It helps with the retention of employees, because the way you issue these instruments, you can also dictate that they have to stay for a certain amount of time to fully realize the gains, right? So it acts as a great way to retain your top talent. This is an example of how total compensation can look like for an employee, in this case over 5 years with a company. Your salary might increase by a certain marginal rate, but the real value, especially when you're joining an early stage startup, taking that plunge, is in your equity, right? So this is an example of how valuable that equity can get as the company's valuation increases. This is the most important slide on the different equity instruments that founders should be familiar with, right? Let's start with options, right? So at the early stage, this is typically around your pre-seed, seed stage, Series A, you would have to come up with some sort of an ESOP pool, right? The reason is when you're getting your first institutional investors, they would ask like if you have an ESOP plan in place, right? Because to attract great talent to join you as a startup founder, you're poaching them from other great startups, mature startups, or large tech companies. They're very familiar with these concepts. They would definitely ask for some sort of an option plan when joining you and taking that risk, right? So you have to create this at least by Series A usually. The earlier, the better. And the reason investors ask for this early on is they want to make sure that you already have a certain amount of shares set aside as your ESOP pool, because if not, they would come on board. And if you create an ESOP pool afterwards, then that dilutes them even more, right? So that's the reason that typically by Series A or even your pre-A rounds, when you're talking to your first institutional VCs, this is common practice to get your ESOP pool in place, right? How big your pool should be is a combination of different factors and objectives as a company. We can talk about that later, but it's typically around 5 to 20% of your company that you would set aside for this pool. So options, how do options work? Options are essentially giving employees a right to acquire a security at a future date at a certain price. That's it, right? So when joining a company, you would typically issue options to employees and they have a certain vesting schedule. This is typically 3 to 4 years in most startups. And they also have a cliff period, right? The cliff period is typically around 1 year. So basically when an employee joins, they're given a certain amount of options that vest over 4 years. And the cliff period, 1 year, essentially means you don't get to touch it unless you stay for at least 1 year. So if you leave within the 1 year, the whole thing's revoked, you don't receive any shares, right? But if you stay for 1 year, a certain amount of the equity vests, right? This is typically, in the case of 4 years, it will be 1/4 of the shares every year that vest. And once it's vested, the employees have an option to exercise. So exercise basically means they're acquiring the shares at a certain price. That's called the strike price. In some companies, in some startups, you might decide to give the options away at a 0 strike price. In some cases, it might be a lower strike price, but it's typically less than what your actual valuation is as a company. So it's a preferential rate that's offered just to employees who have participated in that company building. So that's the way options work. And typically, to take note of as an employee, when you exercise your options, in most jurisdictions, that would trigger a taxing event, because the way the government sees it, you are acquiring an asset at that point, right? Even though you don't have access to cash, it's an asset that's been granted to you, and that triggers a taxing event. So that's options. This is the most common instrument that's used at early stage. Then you have RSUs. So RSUs are restricted stock units. Now, restricted stock units are more common for mature startups. This is typically Series B, C onwards, and public companies, right? So the way RSUs work is you still have a vesting schedule that is the same 3 to 4 years. So a certain amount of stocks are granted to employees, and instead of them having to pay into it, the RSUs, once they vest, they would automatically convert into shares. So there's no strike price, there's no buying into it, which means for an employee, they're protected against the downside. So they might join a company and be given RSUs at a certain valuation. And even if the company raises a down round or the valuation goes down, market conditions change, it's still worth something for the employees. Right? That's fundamentally the difference between an RSU and an option. An option, they still buy into it, and that incentivizes them creating upside for themselves. Whereas RSUs, it's more of them protecting against downside. So you can see why RSUs are more common for later stage companies as opposed to earlier stage where you want to incentivize that growth. And typically, even when you use RSUs, it might be a combination of options and RSUs. The rule of thumb around companies in Silicon Valley, at least, is sort of a 3-to-1 ratio of using options versus RSUs even as you scale, right? PSUs, performance stock units, is very similar to RSUs. The only difference is instead of it vesting just time-based, there's also a performance component. So the way these would work is for executives, let's say, you want to tie the amount of shares they receive to a certain metric that they're responsible for. This could also be a company-wide metric where if as a company we reach this revenue target or this valuation target, then more shares are issued basically. Right? So as opposed to just time-based, you can tie it to individual performance or company performance, but otherwise they operate the same way as RSUs. The fourth one is shares. These are shares directly. I'm hiring someone, you give them shares directly. This is the most uncommon way to go about it because it's not very wise to give shares directly without any vesting schedule. For obvious reasons, it becomes very difficult to claw back. Let's say the employee leaves, and it also triggers a taxing event upfront, just complicates it for everyone, right? So giving shares shares upfront is not advisable, but also it is a mistake that a lot of early stage founders make. Even between co-founders, you should have a certain vesting schedule and not be giving shares upfront, right? Finally, you've got SARs and Phantom. SARs are stock appreciation rights, and Phantom is phantom stock. Now, this basically is all these four instruments that I covered till now are equity settled instruments. The difference with phantom shares are they're cash settled. So the way this works is you're not actually giving out shares in the company, right? This could be for a variety of reasons. You could be wanting to maintain more ownership as a founder. It could be that the markets where your employees are at, it's more complicated to manage shares as an instrument. So you just want to go easy with cash. But in every practical sense, they operate exactly like shares, right? So the way employees would see it and gauge its value is you can basically, it's an imaginary instrument. It's a fake option in a way, right? And the positive side is that you maintain more ownership, you're minimizing dilution and all of that, and it's easy for employees to handle as well. The downside though is because it's cash settled, this is treated as an expense in your accounting. This is a cost for you, right? So as a startup, this would reduce your runway. If you're setting aside $1 million just in employee shares, and that's given through a phantom instrument, that's $1 million less in your balance sheet that reduces your runway as a startup, right? So that's the downside of using SARs, but it's still common to use it in markets where it's difficult to grant ownership directly. So these are the 5 instruments that you should be thinking of as a founder. Just to summarize it again, options is the most common way to go for early stage founders. As your startup matures, you would eventually add in RSUs and PSUs, and you want to avoid direct issuances of shares as much as possible, and phantom where it's more difficult to manage these instruments. So yeah, this is a summary of the different ways you can grant equity to employees.
I learned quite a lot about these things. I was going to ask, hey, what stage should a founder start thinking of ESOPs? And you're saying, oh, when they are pre-Series A or the Series A, and when there's a institutional investor who's going to come, they should already have this allocation done. And my other question was around vesting period. You already answered that as well, where you say 1 year is usually the usual cliff period, and it vests for 3 to 4 years.
Yeah. So some startups may have accelerated vesting, but the norm is 3 to 4 years with a 1 year cliff period. The vesting schedule may also change after the first year, where instead of you having to wait a whole year, it could be that it vests every quarter or every month after the cliff period, right?
Yeah.
Yeah.
So, I mean, I was just going to comment on like the norms that I've seen and whether they're changing or not. I mean, for me, the norm I've seen is that you would have like a 4-year vesting period with a 1 year cliff. That seems to be the norm. So after 1 year, you get a quarter of your share options that you're entitled to, and then every month it vests. So the longer you stay, the more you get your entitled amount. And then, but I've also seen, because of this whole funding winter, that some of the startups are now changing that from 4 to 6 years. And that obviously, if you're familiar in this space and you come to a new startup and they say, oh yeah, we've got an employee stock option pool and it's 6-year vesting period, it can create a little bit of friction when you're trying to attract new talent, because the expectation is 4, but the new being drafted are now 6. Have you seen that before, or is that just like a real outlier?
I mean, so it's uncommon, but it also depends on what the liquidity options are like, right? So for employees that receive these shares, the way they can ever realize these gains are through an acquisition of the company, going public, which is a great outcome in most cases, or some sort of a secondaries buyback program that the company initiates, right? So this could be where a startup raises more capital from larger investors and sets aside, say, if you're raising 20 million, you're setting aside 2 million as part of an ESOP buyback program for early employees, right? Where they get to either cash out partially or fully some of their vested shares, right? Now, if there's a certain, liquidity option, then, 6 years may be fine. If in the middle there are avenues for you to sell, I think that's what employees would be most concerned about. Like, when am I ever going to realize these gains? And if the company has a liquidity program planned in the horizon, then in that case, there's much more clarity around realizing those gains. And so, yes, even 6 years may be palatable for employees.
Yeah. I mean, and we've talked about accelerated, vesting. In my experience, you might have joined a company in year 1, and in year 2, an acquisition comes along, and depending on how it's been negotiated, like your entire unvested becomes vested and you have full access to it. And that's sometimes not explained to employees, that this can happen, that
you'd no longer need to wait the full 4 years for your entire allotment. If there's an equity event, a new company comes in and says, we're going to buy you all out. By the way, here's your cash. And they just, the accelerated vesting is like a lovely windfall for existing employees because they weren't expecting that. And that can happen. So it even happens for the founders and for the employees when that happens. But it's usually not talked about because it just seems to be a dark art. And you don't want to go around, especially as a founder myself, you don't want to set these expectations and then they don't happen as well. But you want people to be educated and aware of what options there are and what potential upside there is. The other thing that we have is that employees will come in and say, well, what does the 0.3% of the stock option, what does that mean? And if you're a pre-series A and you haven't had that valuation event, really hard to kind of explain that to anybody, that okay, this equates to $100,000 or it equates to $500,000. You don't know. So sometimes I find that this whole discussion around alignment of outcomes a little bit hard to manage because you can only align those when people know what something is worth, and if it's not, then people just go, well, it could be worth nothing then, which is true also. And this is the typical quandary I think that founders have. How do I go about communicating this value to the employee? How do I encourage them to stay for 4 years? Because they're clear about the 4-year vesting option, but they have no idea about the real value. And if I stay for 4 years, I could have been working at Google or Facebook and earning $500,000 a year, or I could be scrimping and saving working at this startup and I've got these stock options, but I don't know. I mean, $500,000 is a tempting offer from a startup that's going to just pay you cash. And that's the problem that I think founders do have, as well as new employees coming into a startup. I don't know how you manage that. I mean, that's an open question.
So two things coming to mind, right? The first is education around this, right? So even equity as an instrument is just one part of your overall compensation strategy or your total rewards program as a company, right? So you want to be talking about all your benefits and not just your individual ones, like healthcare is a common question, insurance around that, all sorts of perks that the companies offer, and ESOPs and options, they're part of your total rewards, but they're just one instrument, right? So just education and communication about all of the rewards that your company offers is critical. In fact, something we do as a service is employee town halls, where we share about exactly how these instruments work and get employees on the potential upside of these instruments, right? That's one, right? Education, communication around it. The second, the way I see it, is really a function of the ecosystem at large and how mature the ecosystem is. Because if you look at Silicon Valley, most people understand these concepts, right? They have been through multiple cycles. They know the amount of wealth that can be generated. They know the kind of events that can take place through an acquisition and through an IPO and how much the shares can be worth. And so most experienced professionals would go into companies being very clear about what they're getting into and ask these questions early on, right? Whereas if we look at Asia, if we take India, for instance, you've got really hot public markets, companies are IPOing over there. And again, there is an understanding of what those shares can be worth. Flipkart famously has created a number of crorpatis in India, right? And so there's again an understanding of, okay, I join a company today and one day they'll have an IPO, and then there's a real potential of wealth creation there, right? Whereas in Southeast Asia, just given the nature of public markets, our largest startups like Grab, for instance, had an IPO in NASDAQ, right? And it's still quite unclear what are the ways that founders and employees will cash out other than M&As, IPOs, like secondaries. It's still a developing marketplace for that. And so I just think, as the ecosystem matures, and we're going through that right now in Southeast Asia, and people see how these gains can be realized, then these things are just taken much more seriously. So yeah, these are the two ways I see it. You can combat it with more education, more communication, but then also the ecosystem as a whole has to mature and there'll be more widespread understanding of how these things work.
Let's say I already completed my entire vesting period, right? Say 4 years, I've got all the shares. So then the challenge, like what you're mentioning, is I don't know, like if it's not gone IPO, if there's no ESOP buyback, how liquid is what I have? Like how can I cash out?
Yeah, there has to be a liquidity event, like you said, in the form of an IPO, a merger or acquisition, or some sort of a buyback program that the company initiates. Without that, without naming startups, there are fairly mature startups right now around Series C, D in Southeast Asia, where employees have gone through this cycle, right? Have finished 4 years and have even left those companies, but they still have shares. But they're just on a list. When there is a liquidity event, they'll be eligible to sell, right? But they haven't realized those gains yet, right? So the way I see it is a function of the ecosystem and the options that companies have in terms of the capital markets and the public markets to actually enable these liquidity programs. We actually enable a lot of this in India, for instance. Qapita has a business of enabling secondaries over there through our marketplace.
Okay. And how come you only do it in India and not elsewhere?
It's on the horizon.
Yeah, asking for a friend, that's all.
Yeah.
So I've got a question around like Qapita, the platform, right? So like what you're mentioning earlier that, this Osman was saying how sometimes the equity or the options that you have, they're vesting on a monthly basis, right? So imagine if I was running a small startup, then I tell my corporate secretary, and then they are the ones who will tell the employee, hey, now you own this amount of shares. Whereas I would think like of a platform like Qapita, it will maybe send me an email and I can log into the portal and see what I already have secured and what I already have left to go. Like maybe if you could tell me how that looks like from more of an administrative kind of perspective.
Yeah, absolutely. In fact, at the early stage, it's typically founders themselves managing the platform, where they can manage their cap table. They can do scenario modeling on what their cap table would look like as they get future investors, what the dilution would look like, and they can plan for their fundraising events. And from the employees' perspective, it's one portal where you can manage the shares issued to employees, and employees can log in and see what the vesting is like, the value of their equity. And in more mature startups, it is administered through the HR and finance department that manage this for employees. And essentially we had something called the equity pay slips, right? So it's essentially like you have salary pay slips, right? You want to see what your equity is worth as they vest. So these are things that platforms like ours enable.
There's going to be a question around pricing, but I'll leave that till later, like how much it's going to cost.
We have a free tier for founders that just want to get started with the software tool. And for helping you design an ESOP plan, we can come in through our consulting practice. And for larger startups, we even do valuations for their ESOP pool. But as a starter, if you are a follower of Clueless Capitalist, just tell us that Razi and Osman sent you, and we'll have a special discount just for your followers.
Cool, because we really negotiated hard for that one, everyone. Yeah, we've got your back. This is the thing that I think will jump out at most people, this comment around the secondaries, because you'll get employees who leave and then they'll say, well, how can I sell my shares? Now, I mean, I was talking to a VC the other day, and he goes, well, this is kind of the trade-off, right? That it's not liquid, but with that lack of liquidity, there is the option that you get the massive upside if it does happen. So if it was very liquid, you'd have loads of people trading day in, day out, and that can potentially depress the valuation quite significantly, because the nature of startups is that you can have like a really, really good year and a terrible year or a terrible quarter, and that can really impact the value of the company. When you've got a limited market and you've got limited options to sell, the trade-off is that it can be, when the liquidity event does happen, it can be significant. So you trade off with the lack of liquidity with the fact that it's got a potentially very high upside, and a lot of people forget that. You can just go and buy shares in a big company on the stock market, and you're not going to get a 5,000% return on your shares unless you happen to time the market really well with something like Apple, right? But with a startup, you can have your options and walk away very, very wealthy. But the trade-off is that there isn't an active liquidity pool that you can trade your shares. That's the trade-off that you have, and people need to be reminded of that, I think. Yeah, and for me, just going back to some of the the points that you're bringing up around the different options that there are. I mean, as angel investors, as we've gone through the whole cycle of investing, converting to shares, and then taking an exit, things such as anti-dilution and pro rata rights, and the restrictions that you would have as well if you're now given shares that you can sell on the stock market. All of those things really you're not familiar with and not aware of. But if it was just through a secondary to another incoming investor, do you have any advice for angel investors as to what they should be entitled to or should be watching out for? If, for example, I'm an early stage investor, Razi comes in and says, oh, I'm coming in, I want to buy out Osman because he's got 0.25% of the company stock. What's the typical approach here? How does that normally work? Can you share any insights?
This can really vary from company to company and just the relationship founders have with their investors. But I would say from a founder perspective, and I know you just had Olivier from Optimate on the pod here, he would have spoken about this. Founders should also be familiar with the concept of SPVs, special purpose vehicles, to organize your investors and keep your cap table clean, right? Again, a common mistake founders might do is you end up with a cap table of 50, 100 investors as you raise more capital. It becomes quite difficult to manage as you get future investors, especially VCs on board. And so the way you manage that is by using SPVs, where a bunch of investors sit within a single entity on your cap table, right? And you could have discussions early on with them on how you plan to handle the SPV as a whole when you get your first, let's say, VC on board, right? So as opposed to having those individual discussions with individual angels, again, an angel syndicate really simplifies this on both ends, right? For angels and founders alike. But just using tools such as the SPVs, you can kind of streamline the different buckets of investors you have and accordingly have conversations on how you'll treat each one differently depending on the stage they came in and the value they're adding.
Yeah.
You should create a Qapita GPT or something, like a custom GPT.
Oh, yeah.
All the integration to make it available to startups. They go there and ask questions, and then from there, that actually becomes a good source of lead generation. Like when I go to the GPT store, I see some good quality GPTs. I click through, it actually brings me to something they can buy. Yeah. Maybe you guys want to consider creating a Qapita GPT.
Yeah. I see Aspire has put out something like a founder co-pilot, like a GPT that they made publicly available. Yeah, I think it's a great way for a lot of B2B companies to engage a long tail of free users before they eventually, part of them become paid subscribers, right? So, yeah.
Thank you, Jaya, for bringing us through the work that you do at Qapita and helping us make sense of ESOPs for startups. And you've heard from Jaya. If you are one of our subscribers or listeners of the show, please do reach out to him to see the special deal that he has put aside for our wonderful subscribers. So if you enjoyed the episode, please remember to like, comment, share, and subscribe, and we'll see you on the next one.
Thank you.
Thank you for having
me.
See you.